Who's more likely to fire someone via email?
You.
No, you.
I would fire by email.
Yeah, you. I would never do that.
Okay.
Yeah, that's
But
you.
but I just didn't think you would like firing people.
Yeah.
Yeah.
I don't like firing
Well,
people.
nobody likes it. I hate firing people. One of the hardest things an entrepreneur has to learn to do is be a good people manager, and firing people is part of it. And my first half of my career I was terrible at it. And then I learned how to do it right.
Your first firing as an entrepreneur is always really bad and ugly.
Oh my God.
Really, I cried.
First time I did it, it took 2 hours. She cried, I cried. She hated me afterwards. It was just a terrible process. When I learned how to do it correctly, which is generally quickly and efficiently and businesslike, the person respected me more, liked me more, and it was faster and quicker and less painful.
This was not my first firing, but one of the horrible firings I had in my career. I distinctly remember I fired him, and then he asked me for a ride home. He didn't have a car. Welcome back to the Startup Ignition podcast. We are now on episode 3. It's been fun filming these things. Thanks to everybody who's tuning in, watching, learning, understanding, and on this journey with us. Again, I'm Tyler Richards, entrepreneur, general partner of Startup Ignition Ventures, founder of Startup Ignition with my dad here. This is John. Hello. And let's get into it. So last time we had a little icebreaker that I thought was fun. So we're going to do another icebreaker.
Uh-oh. He's not prepping me for any of this.
And this time I did not prep my dad because he ruined it last time. So I did not even send him the agenda this time. But we're going to play a game. And here's how it's going to work. I'm going to read the following questions, and it's called Who's More Likely? Okay? And you're either going to say me, you, or neither.
Okay.
That's all you got to say. And you can go into explaining it because I might defend myself.
Okay, there you go.
Okay, here we go. You ready for the first one?
Yes.
Here's the father-son icebreaker for this episode. Ready? Who's more likely to invest in a terrible idea just because they know the founder? Me, you, or neither?
You.
Me. I agree. He's going to stick to the tried hard principles, and I feel like I could be swayed off of that and invest in someone that I know. Okay. Number 2, here we go. Who's more likely as an entrepreneur to pitch a startup idea that already exists?
Wait, say that. Who's more likely?
Yeah, who's more likely to pitch a startup idea that already exists?
Between you and me?
Yeah, between me and you.
Maybe me, because you might be more aware of current, youthful, younger things.
That's exactly where my mind was going to.
Okay.
It was like, I'm on the trends. I understand the waves. I'm in the news. I understand what's happening in younger entrepreneurship. And I feel like you might miss some innovation or tech or something. You're like, oh, what about this? And it's like, that already exists.
I don't like conceding that, but I'll concede it.
He concedes. Okay. Who's more likely to completely ignore an Excel spreadsheet and make a gut decision?
You.
Me, 100%. I might have rigged that question. Yeah, I'm way more kind of off the cuff.
Well, we just spent 90 minutes
on a spreadsheet
mentoring with a company we're looking at investing in with their spreadsheets, and I have a lot of experience in that.
Yeah, so I tip my hat to him when it comes to financial workbooks. Here we go. Who's more likely to start and exit a billion-dollar company before the other?
Probably you. I'd say you.
I disagree on that one.
Really?
I disagree on that one.
Oh, really?
I feel like because you've taken a company pretty far to an IPO that you probably would have more stick-to-itiveness.
But from here forward, I'm too old.
Yeah.
I don't want to be in an operating company anymore. You may be someday.
Okay, that's true.
So that's why.
So you're saying if it's going to take 15 years, me. But if it's going to be a 3 to 5 year plan, I say you.
Yeah. People know that we're from the Utah market, and people don't realize even the most successful company in Utah history took a long time to achieve its greatness.
Successful in what terms?
Well, it's Qualtrics. Okay, the
Oh,
Smith
yeah,
family.
8 billion.
Ryan Smith, our local billionaire, bought the Utah Jazz, and he was a student. I mentored him a little bit or talked to him when he was a student. And I had an office right by his father, who was the founder of the company. And people don't realize, I mean, that company's 25 plus years old right now.
Yeah.
I mean, they were, 12 years in a basement or a dingy office.
Yeah.
And
So you're saying to get to $1 billion, that's a long path.
Takes time, way more time. The average exit for any software startup, the average is 7.9 to 8.2 years. So it takes a long time. And if you're going to get to $1 billion exit, it's going to take longer. I mean, the real big unicorns, the exits often are 10, 12, 14 years. And so that's just how it is.
Yeah, I would even say 15 years.
Yeah, and so, but also, but even you experience, this is interesting to just share, like once you've kind of made money where you're kind of set and you don't have to really work again, that 60 plus hour grind a week, which you've experienced, I've experienced long ago, it's hard to be operational again, but it's way more likely from this point forward that you would do an operations role in a company to build $1 billion company than I would, because I don't want to work that hard. I want to enjoy the fruits of my labor for the years I have left, and I don't want to get into a 15-year grind.
That's true. That's true. Okay. So next one, here we go. Who is more likely to launch a startup or product without validating?
Well, I think we're both susceptible to that because we're human, and many can be susceptible to that. You and I have done that to some degree once or twice.
Yeah.
But going forward right now, I'm really married to the lean startup process and validating, but I think you are too. I think that's a 50-50. What do you think?
So neither. I would say, I would argue
okay.
neither.
That's what I said. So if the likelihood is 1%, we're both at 1%.
Yeah.
Okay.
But I'm saying the actual answer would probably be neither.
Yeah, exactly.
Okay. Who's more likely to fire someone via email?
You.
No, you.
I would fire by email.
Yeah, you. I would never do that.
Okay.
Yeah, that's
but
you.
But I just didn't think you would like firing people.
Yeah.
Yeah.
I don't like firing people.
Well, nobody likes it. I hate firing people. One of the hardest things an entrepreneur has to learn to do is be a good people manager, and firing people is part of it. And my first half of my career, I was terrible at it. And then I learned how to do it right.
Your first firing as an entrepreneur is always really bad and ugly.
Oh my God.
Really, I cried.
First time I did it, it took 2 hours. She cried, I cried. She hated me afterwards. It was just a terrible process. When I learned how to do it correctly, which is generally quickly and efficiently and businesslike, the person respected me more, liked me more, and it was faster and quicker and less painful.
This was not my first firing, but one of the horrible firings I had in my career, I distinctly remember I fired him, and then he asked me for a ride home. He didn't have a car. So I was like, sure, that was an awkward car ride.
Yeah.
Okay, next one. Here we go. Who's more likely to take a meeting with an investor just because they're famous?
You.
Me, for sure. He doesn't really care about the current happenings. I mean, you get into the modern if celebrity news.
If I know that piece of current celebrity and you have a much broader knowledge of that. If I have a sliver that's important to me, it could be, but it's also from an era. Do you remember going to a venture gathering and Peter Vidmar was there?
Yeah.
From the 84 Olympics.
Uh-huh.
And you had no clue who he was. And I was like a fanboy.
Yeah.
Yeah. Right. And he was an old guy. He used to look young. I hadn't seen him since he was in the Olympics. And when he was young and a top gymnast and gold medal winner and all that. And we sat like right next to him and we talked to him all night.
And you made us all take a picture awkwardly.
Yeah. And you had no idea who he was.
I was like, who is this guy?
Yeah.
So maybe me. I agree.
But you would be for most things.
Yeah. So next we have 2 more and then we're done. And then we'll get into the meat of the podcast here.
Okay.
Who's more likely to make more pivots in a startup within the first 6 months? Me or you?
More pivots. That's one where I think, because you're now fully indoctrinated and believing in lean startup to the level I do, it's about even.
I say you. I think you would over analyze a lot more things and make more micro pivots than I would. I would probably glaze over things where you would get even deeper into the weeds and be like, no, we got to do this, and this.
Kind of really blunt and decisive.
Yeah. So, and if we analyze every pivot, which is a pivot from micro pivot to something very minor, all the way up to major pivots, which is changing your business model almost completely, I would say you.
Okay.
Okay. So,
and I tend to be more blunt and decisive. And once I've made a decision, I just do it.
yeah.
Yeah. Okay.
So then the last one, here we go. I like this one. Who's more likely to run a company that raises and burns $10 million before making $1 of revenue?
You.
Me? I do not agree with that.
I wouldn't be.
I wouldn't.
I'm pretty famous for being frugal.
Yeah, I think we're both pretty frugal. I don't.
No, yeah, you are. You are very frugal too. So, but I just would say the only reason I would say you is because I have more experience.
Yeah, but I would argue that's probably a neither. But I definitely don't think it's me.
Yeah,
I just couldn't. I couldn't take in that kind of capital, squander it, and not achieve something.
Neither of us do it. You've heard my Google stories. Do I need to tell them right now?
Yeah.
You want me to tell you? I don't know if anybody knows, but I took a weird departure at age 50 and was head of operations for Google in the state of Utah. I helped a city sell its fiber network to Google Fiber, and then they turned around and asked me to head it up. But during the 2 years I was there, I got in trouble twice for being too frugal.
Yeah.
And it was just crazy stories. And maybe I shouldn't tell those stories.
Well, I don't think anybody cares, and you've moved on from that. It doesn't matter who hears it.
Yeah. So one time a PO, a purchase order, was put in front of me for $38,000 expense to rent an ice cream truck to have people run around Provo, Utah and give away ice cream to promote Google Fiber. And I would not sign $38,000 for a 1 month rental of an ice cream truck. Are you kidding me?
Insane.
Yeah. And so I wouldn't sign it. And unfortunately, the powers that be at Google had to call me up and say, John,
just sign it.
Sign the PO when we put it in front of you.
Yeah.
And I said, don't you want me to treat this like it's my own money? No, we don't. This is a sandbox. We're just trying to find what works.
Yeah.
And that's a fish out of water experience for me. And I've had cases where I was trying to save money on parking with 3 Google executives driving from Mountain View to San Francisco. And I tried to save money on parking. And they said, John, just park the car. Anyway.
I think in a startup, it's a different story. Google is Google, but like in a startup, I definitely would never spend $38,000 in an ice cream truck to do marketing, like localized marketing.
But I wouldn't do it if I was part of Google because it's ridiculous.
Yeah,
anyway.
Either way, it's ridiculous.
Yeah.
Okay, we're done with that one. So I don't know who's been keeping score, but who's more likely to do what. But maybe we'll have Jordan put up a graphic and tally up the who won.
Okay.
Okay, moving on. So I thought we would maybe shape this episode around a little bit more of fundraising, like startup funding trends, fundraising, what we're seeing, because again, we are venture capitalists and we run a pre-seed venture fund. And so we're literally in the trenches every day, talking to startups, analyzing startups, identifying what the market wants or what the market is demanding, understanding obviously what we look for, our thesis and what we want to invest in is probably different than a lot of other venture funds. But I think overall the landscape is pretty talkative, and we talk a lot. VCs actually collaborate a decent amount, share knowledge, share information, share deals, share infrastructure. And so
just the sheer number of pitches we hear.
Yeah.
Yeah.
But I'm just saying, so I want to take this episode and start off talking a little bit about fundraising, because I feel like it's such a hot topic in startups where a lot of entrepreneurs and founders feel like that is the ultimate goal. And I think we've even talked about this on episodes past, where a lot of founders feel like once I raise capital or once I raise a round, like, man, I am in the promised land.
I've arrived.
Yeah, I've arrived to the promised land. And that's really not the case. But because of that mental attitude and that thinking around fundraising, it's on the top of everybody's minds.
One of my favorite things to do is when I have a group of entrepreneurs in the room, let's say 20, 30 entrepreneurs, I'm teaching or mentoring or training, and some of them have raised money. I'll have the people who's raised their first round or second round of funding in here, and they raise their hand. And all the other entrepreneurs that haven't raised money yet and are wanting to, and they think that raising the money is going to mean they've arrived and achieved things. And I always ask the ones that raise their hand that have raised money, I say, okay, hey, when you raise the money, Did all your problems stop? Did it solve all your problems? Did life get easier or did it actually get harder?
Yeah.
Do you have more accountability in your life? Are you worried more now? And all of them say, yeah. In other words, actually, the day you deposit the money from your investors in your bank account, it's exhilarating and fun. But actually, when the real work starts and accountability starts, and it is not solving all your problems, and if you get too much money, more than you need, it can be a source of destruction of value instead of increasing value. But that's a whole nother topic, maybe for another podcast.
Yeah, I always, when I think about this topic, every summer or so, we get our Startup Ignition Bootcamp alumni together for a large event, because the way the bootcamp works is it's cohort based, like 20 to 30 ventures enter in each cohort. So if you're not in the same cohort, you really don't know a lot of the other alumni. So we try to do a reunion event every year. Yeah. And our last one we held was last summer, and there was about 500 people there. And I think we had this question of like, who has raised money? And I think you asked that in front of everybody. And those that raised their hand, they're looked at as like, oh my gosh, that's where I want to be. I want to be in a situation where I've raised a decent round on my startup and I'm going to town, going to the races and building what I want to build.
Yeah, and we held at that reunion at the largest VC in the States office.
Yeah.
So, and we had the managing partner there speak. And so fundraising was a main topic.
Yeah. It was a huge topic, that whole meeting and that reunion. Yeah. But, so let's dive into fundraising a little bit now. And there is a few things that I want to bring up. That yes, we all know that fundraising is down, that in 2021, 2022, obviously that was the height of fundraising. And right now, it's not at its peak highs or what it was just a handful of years back. But there was a Forbes article that I want to bring up today that was entitled "Why 2025 Looks Like a Big Year for Venture Capital," and it just discusses the expectations of a resurgence of venture capital because there has been such a lack thereof 2024 and 2023. And so I want to go over this article. Maybe we can have Jordan again pop it up here, and I can even just throw it up on here on my screen. But it basically goes over how a lot of the venture ecosystem is really optimistic for 2025 to be a year where there's going to be a positive global economic outlook, advances in technology, and a renewed interest in a ton of different sectors, and just excitement overall.
Yeah, but that shouldn't surprise you. You've been hanging around me for the last few years. What did I predict?
No, but it's surprising that that's being confirmed overall in the general venture capital market, because we've been saying that in our close circles for the last...
Yeah, but we've predicted it.
Yeah.
We know exactly how it's going to go because of experience, and it's just we don't know the exact month that things are going to tip one way or the other, but... Years ago, we knew this would be this way.
Yeah.
Yeah.
But there's a part in the article that I'd love to get your thoughts on that actually really generally aligns with Startup Ignition Ventures and mine and your thesis around building in venture, because I feel like even the last, not just since 2021 or 2022, but even the last 10 years, there's been this huge movement in venture capital where growth at all costs, where the venture capitalist game was like, raise massive amounts of money in a fund, throw massive amounts of capital at these different startups, and just cross your fingers for the one that works best. Obviously, not just like on a whim, but like doing due diligence and picking a handful of winners. And the ones that succeed, great. Let's even throw more money at them. And the ones that fall away on the wayside, whatever, they're gone, they're dead. And this article talks about how in 2025, they see that shifting, that there's going to be a focus towards sustainable business models, that there's going to be a focus on profitable business models and moving away from that rapid growth at all costs. And that there's like a whole section about it. And I was like, I felt validated. I was like, wow, this is exactly what we preach. It's almost the whole model around Startup Ignition, that you don't have to go raise tons of money, reach a huge, massive valuation. And that's how you make tons of wealth for yourself as an entrepreneur. In fact, there's a whole different side of entrepreneurship that we've been talking about for the last 5, 10, 15, 20 years, and even what I implemented in my own startup, which is don't raise as much capital as you can, bootstrap as much as you can, preserve a lot of equity for yourself, and then exit for a much more obtainable and accessible and achievable outcome. And you'll actually have the exact same amount of wealth at the end of the day, right? And this is something that you've talked about forever, but it's in this Forbes article that just came out in January of 2025, just recently, like last week.
So here's my feedback to that. And I know you're loving that it being validated, but for me, I just say, duh.
It's basic business.
Duh. This is, it's core to our beliefs in entrepreneurship and venture is the power of cycles. Every asset class is subject to the economic cycles of the macro economy. And so this is completely predictable. The only thing we can't predict is the exact moment when things turn, but it's really important.
The exact moment when things peak or valley.
Yeah, where the troughs and the valleys head towards the peaks, and then where the peaks downturn towards the next trough. But these cycles happen. It's as predictable as the sun coming up in the morning and the sun going down at sunset. And so it's just not quite as predictable the exact moment in time. And so this is really important, though. Super, super important what you're bringing up. And this is happened many times before. Even the father of lean startup, Steve Blank, has written about this. I've written about it. I've talked about it. And it's just the fact that even a huge thing was coming through the dot-com experience. As the dot-com experience got to dizzying heights in the year 1999 and 2000, and then completely crashed in mid-2000 and a terrible 2001, 2002, 2003. This happens all the time. And every time we go into a trough, there's a return to, we got to have profit. We got to have sustainability. We got to do the right things. We got to be careful and do real business.
Yep.
And then things get going so revved up
and big.
All of a sudden we lose that and we get into the bubble territory where nutty stuff happens. So as an investor, what do we want to do? As an entrepreneur, what do we want to do? We want to start things in the trough, be very careful, ride the early wave of people looking for smart, sustainable, disciplined leaders and entrepreneurs, and capitalize on that. And then when do we want to sell those assets we've built up in venture?
Yeah.
At the bubble,
at the
top. When everybody else is throwing money in at the bubble, we're selling. And in the trough, when everybody's not investing, not starting, we're investing and starting. This is how you create wealth.
Yeah.
But it's buy low, sell high. There's no secret about this process. It's just the hardest thing for a human to do. Buy low, sell high. Buy low, sell high are 4 words that are super important to every financial asset class. And it's super hard for humans to do that. We get caught up in the disillusionment of the negative trough, and we get caught up in the irrational exuberance of the bubbles. But one of the things you've had a little bit of privilege is learning from me earlier in life because of my experience. I've shared with you these cycles. You're now aware of them. It took me a lot of time to learn this is what needs to govern my behavior.
Yeah. And just to double underline all of this as well is that there's another article that I found that was from the Wall Street.
Well, before you get to the next article.
No, this is exact.
Yeah, I just want to say though, we can completely concur with that first article.
Yeah, but we concur with the second article too. I'm saying it's saying the exact same thing.
Okay.
So there's a trend moving here.
Yeah.
Right. That these new investment strategies that VC is moving towards smaller funding rounds, lower valuations, and quicker exits when like 5, 10, 15 years ago.
Sounds like our playbook.
Yeah, that's what I'm saying. That's why I said I feel validated.
Yeah.
And this Wall Street Journal article is entitled "Venture Capital Needs a New Math. Try this formula."
Yeah.
And the whole article is about that movement towards that there needs to be smaller funds that take smaller funding rounds and get quicker exit and prove traction and get to an exit based off of real business, not off of hype or overhyped valuations, right?
And we've done this. We could tell a story of what you and I did together. We funded a company that became $1 billion unicorn, but we sold out early, got a 44x return. And today, sitting here today, maybe the founders took some chips off the table where they could calculate a higher return, but nobody else of the hundreds of millions invested in that company, no other investors have gotten anything off the table.
Yeah, well, maybe explain why maybe for those who are new or a budding entrepreneur or trying to get into entrepreneurship or starting their own startup or just getting into fundraising and trying to understand the landscape, why is a high valuation early on in your startup, or even a lot of capital raised off of that high valuation,
Why it's not a good thing?
why it could be detrimental.
Yeah. Well, first of all, there's a term called, we've got to grow into the valuation. What does that mean? Grow into the valuation. If you get an early round that's too high for where you should be and get too much money, a lot of nefarious things happen. Too much money too fast will lead to squandering of capital. And no matter how disciplined you are as a CEO, for instance, and all your organization knows you got a pile of money sitting in your bank account, when they come to you, for instance, this trade show is only $40,000 to be in the trade show. It's only going to cost another $30,000 for building the booth. And we're going to send
hotels,
6
flights,
people there and all that. And as a CEO, you're going to, want to say, should we be spending this money? But the impetus, the motivation happening inside your company is, we got to go grow and build revenue up. We got to do these things. And so you just start spending money, and it just starts getting out of control. And that's the danger of getting too much money too fast. The nefarious part of getting too high of a valuation is growing into the valuation. You don't want to set yourself up to have a down round, or even worse.
So give some numbers, give some examples to that. What does that mean?
Let's take 2021. What did we see? How much agony have you and I seen from people funded in 2021?
Yeah.
In the hundreds and hundreds of companies we've met with. Okay. Yeah. Let's tell a story. We won't name the names. Okay. We one time ran into a company that got $6 million at a very high valuation.
Yep.
With no business model and revenue.
Right in the middle of 2021.
Plus took a $2 million loan on top of that from Silicon Valley Bank.
Yeah.
Okay. So they got a venture equity loan or investment of $6 million.
SVB does that. They will do that.
No problem at SVB. That's what they do.
Yeah.
But $6 million equity, $2 million debt on top of it, guaranteed by the founders.
Mm-hmm.
Okay.
Personal guarantees.
Okay. In 2021.
So they have $8 million of capital.
And they quickly got to $350,000 a month burn rate, which gives you just about 2 years.
Mm-hmm.
Okay. And never really found the business model, never really got it going, and just never laid anybody off.
Mm-hmm.
Went 2 years and woke up 2 years later in mid 2023 and laid off everybody. And just the founder was left sitting with nothing except $2.4 million with interest, $400,000 owed to Silicon Valley Bank. And we saw that repeated many, many times. And that's the problem with that. That high valuation raising $6 million.
Yeah, because
I think they were in the 20 millions of valuation.
Well, that's what I'm saying. So $8 million raised, their valuation was probably about 25 million.
20 to 30 somewhere.
Yeah.
And the pressure to grow into that valuation is huge.
And for all of our listeners listening, that $30 million valuation, right, usually would warrant some form of revenue, right? You have to have some kind of multiple off of revenue.
It depends on the venture investors. There's a lot of venture investors that encourage this.
Yeah, but I'm just saying that's why you're kind of setting yourself up for failure, because if you're already raising at a $30 million valuation on your first round of capital coming in, what's your next round of capital going to be?
I'm smirking and laughing because it's just ridiculous.
Yeah. So let's say you have to raise at 40 or 50 or 60 million on your next round. Then what kind of revenues do you have to achieve to be able to go get that next round? You're just setting yourself up for failure. So that's what he means. Growing into a valuation is hard.
We also are privy to a lot of information. So we'll share it in round terms. We know, we'll take Tiger Capital Management, the number one investor in the world in venture in the year 2021, Tiger Capital Management.
As far as capital deployed or
yes,
fund
like
raised.
$6 billion invested in 2021. And I don't know the exact facts right now. People can look this up and check, but a gargantuan 60, 80% or more of their portfolio is down. It's a complete devastation. And that's the problem with that. And we also know, even locally in our own regional market, that we know venture investors that did 100 different investments in 2021 with 60 to 80% of those companies basically almost out of business.
Yeah. Okay. Yeah. It was a tough time. So again, setting yourself up like that is at a high valuation or a high amount. Basic rule of thumb when you're going to fundraise the capital that you actually truly need, not an exuberant amount, and make sure that your startup warrants that kind of capital or warrants that kind of check size. Because if it doesn't warrant it and you're just like, I'll take it because the money's there, it's gonna be hard to fundraise or continue on that kind of trajectory and fill in those big shoes that you set up for yourself.
Can I also tell you something you've heard me say in some VC meetings, and it's true? The whole thing, though, we talk about all these different moments in the cycle of trough and the valley and the behavior going on. We will be there again. Right now, people are saying, be smart, do good business, and this is what we like. Right now is a great time, right?
Yeah.
3, 5, 7 years from now, at some point, we're going to be in a bubble and people are going to be making stupid investments and it's all going to repeat itself.
What is it?
And then we're going to have another bubble burst and crash.
Yeah.
And it's going to go. I've been through 4 or 5 in my career. In our pitch deck in our venture fund, we go through all those cycles, what investments we made, what we reaped from them, and how it's all worked. And it's just literally as dependable as the sun coming up and going down.
Right.
Yeah.
So let's close the chapter on that. So that
Okay.
Now let's move on to maybe a little bit more of a personal experience, because as we are VCs and we are looking at pre-seed companies all the time, we're literally deploying capital as we speak. Literally wrote a check like 2 weeks ago to our newest portfolio company. But I thought maybe we would analyze a deal that maybe the top 1, 2, or 3 that we want to fund right now, because we have a continuous pipeline of startups, right? We're talking to tens, if not, you mean
just generically, not by name?
Yeah, not by name.
Okay.
We're not going to reveal anybody's name or any information or data that could be tied back to them. But I was thinking, how cool would it be for our listeners and viewers to maybe understand what we look for in an investment, and we can maybe talk about our top 1, 2, or 3, or even the one that we talked to today prior to this call. We had, again, a 90-minute conversation with a founder that I
also received an email in the last 24 hours by somebody that we've turned down that said, why is it that we're not a fit for you? And what is your must?
Yeah.
And I just wrote that email an hour ago to that person.
Yeah.
Here's the must.
Yeah. So that's what I think it'd be pretty insightful for everybody to understand at least what we look for, and maybe bringing real world examples to the table right now and talk about what is it about the founding team? What is it about the model? What is it about the opportunity? And what is it that gets us going?
Okay, why don't you take each of those subtopics by topic, and we'll just comment and move on.
Yeah,
you lead the conversation.
Yeah, so here we go. So let's keep in mind the probably one of the number 1 investments that we want to do if everything continues to go on plan, because due diligence with Startup Ignition Ventures is a bit rigorous, and we have multiple meetings before we'll ever write you a check. This is not just something on a whim where we go, oh yeah, sounds good. Here you go. We trust you. Go take $500,000. No, It doesn't work that way. We have a fiduciary responsibility to those who have invested in our fund to deploy that capital responsibly. And so let's talk about our number 1 probably person that we are hoping to invest in if everything goes well.
Instead of the type of business, you're saying the founder first.
Yeah. So let's just talk about everything, the aspects and attributes of a fundable project.
Okay, but if you want to, well, if you want to go in order of kind of, is this the right type of business model?
Right.
Okay.
Right.
But that we can go over genre of business.
Okay. So let's go over it. What did we like about this deal? So
of this deal, what we like about it?
Yeah. So we had a conversation literally an hour before the filming of this podcast with this team and with this founder, going over a part of our due diligence process.
It's actually not in our sweet spot of B2B SaaS, though.
It's not. But it is still an attractive deal. So
it's a SaaS business, but it's not a B2B vertical SaaS workflow management software.
Yeah. But
which is, by the way, our number 1 favorite.
Okay, so let's talk about then why are we moving and why are we favoriting this
founder?
Deal? The founder.
Yes.
Okay, so what stood out about him or the founding team that is like, wow, okay, that is something we look for.
And by the way, we distinguish founders as in our way of working. We have primary, secondary, and tertiary founders.
Yep.
So a primary founder is usually, not always, the one who's originally came up with the idea, has the passion and came up with it, and is going to emerge as the business side CEO.
Yeah.
Okay. That's the primary founder. Very, very important consideration. That person is who we look at heavily. And then there's secondary and tertiary founders. But the primary founder is critical. And
relating back to this deal, what's attractive about him? With all these attributes, let's go back to this specific deal that is probably number 1 on our list right now.
Okay. He is extremely detail oriented. He's extremely passionate. He's extremely thorough and thoughtful, and he's had a success in the past, although he did not take off enough money from that deal in the past for what he created, because he didn't have some of our trainings and teachings.
So a strong track record.
Well, no, strong track record is not always it. But that helped with him. But it's more of those ones I said beforehand.
But a previous founder.
Yeah.
He's not a first-time founder.
Yeah. And here's on this particular one, he's got those attributes I said before that. And then because he had a successful deal in the past, even though he should have had more wealth creation for himself from it, he didn't have as much because he didn't know some of the things that we teach people to make sure that they get to that finish line. Okay. But he knows how to do it.
Yeah.
Okay. And then with our new teachings to make sure he does it right, to preserve his position and do it correctly. And then he's got all those other positive attributes. What we do, he is what we call an excellent practitioner. I'd say he's in the top 2% of the people we meet that will conduct lean startup correctly. And we've seen that.
Yeah. He's proven that over the last 3 months.
When he comes up with a financial projection model, it's excellent.
Yeah.
Okay. A quality.
So he doesn't really have industry experience, because that's a huge factor.
Well, that's founder market fit. But I do think he has founder market fit here in the macro way, because his previous company was all about movement and accuracy and protection of data.
Yeah.
Okay. He's doing that same thing, but in a different vertical, different industry, in a different way. But that he's got strong data experience.
Yeah.
And he found an incredible opportunity. Okay. Around data in a certain industry. We're not going to share any more than that. But he went and did his due diligence, and he's created connections in the industry. So right now, even though when he started the idea, he didn't have founder market fit the way we traditionally would love it, I think right now he's got great founder market fit. Yes.
But overall, he's coachable.
Yes.
He's resourceful.
He's
smart, adaptable.
Super smart and decisive, but also teachable and humble.
Yes.
Yeah.
Which are great attributes in a founder.
Yeah.
Okay, so let's move on from founder. What about the market opportunity? What about the timing of the model or of the idea? What did you like? Is this a huge and growing market?
Yes.
Is it a real problem?
Yes. What he is addressing is you and I have talked to his customers. He has a handful.
Yep.
And they rave about it.
Again, our due diligence process is rigorous once we actually write a check, but we are writing checks. But look, we're talking to customers. We're getting into the market. We don't know anything from anything in this market, but we're trying to.
But we do now.
Understand it, right?
Yeah.
We have to.
So he's found, and just scratching the surface of his opportunity, it's gargantuan.
Yeah.
A huge TAM.
So it's a huge and growing market, first of all.
TAM meaning total addressable market.
Total addressable market's big.
So the market and the overall huge sector, or even macro sector that he's in, is so important to the future of AI, electric vehicles, energy, all this. It's gargantuan. Government requirements around it.
Municipalities.
And what he's addressing, and he's found an incredible problem, and he has solved it.
So are you saying timing then? The timing of the opportunity is right?
Well, just the size of the end, everything's come together. So let's boil this down and make it something that's digestible for the listener or viewer, is in terms of the market. Huge market, important to the near and long-term future of humans on planet Earth, okay, which is true.
Yeah.
It is true in this, right?
Yeah.
And an intense, serious, labor-intensive problem that needs to be fixed.
Yep.
With technology and efficiency. It's got all that.
Okay, so is that so the business model is right, the opportunity is right, the founder is right. Revenue potential, that's obviously going into this equation, because I think he's demonstrated that.
He has 70, and this is going to be weird to people because they might not understand it, 70 products he can come out with. The first product alone is investable.
Yeah.
And he's got 69 others.
Yeah.
Okay. And
it's scalable.
Yes.
Highly scalable.
Yeah.
Highly scalable.
Yeah.
It could be rapid growth. That's a little bit of what we're taking a bet on.
We don't push for rapid growth. What do we push for?
Steady growth.
So a discipline. So one word about him too is discipline. A disciplined primary founder who knows it's really important to nail your business model, then build the infrastructure to support scaling activity. So it's nail, build, scale, not just nail it, then scale it. It's nail, build, scale. And so he knows that he needs to build the infrastructure to support the scaling activity that will happen when he's got that infrastructure in place. And that's a very important thing too. Yeah.
And he does have a little bit of traction, but more than traction, it's validation that he's done. He's done a lot of validation work around this idea.
Yeah. But validation and traction have a fuzzy line between them.
They're kind of interchangeable.
I personally believe, and for those, hopefully listeners and viewers here are familiar somewhat with Lean Startup. If not, get familiar with it. But Lean Startup is about going and talking to your customers before you start building a product, before you start spending money, and finding out if your hypothesis for that a problem exists and your hypothesis that there's a target market that wants that problem solved, if that's all true.
Yeah,
And
any
it's
guess
not just
around
a
the
guess.
business. Yeah, any guess is true or not.
Yeah, if it's fact. Okay, so, but Lean Startup activity, and why I said there's a fuzzy line between validation and traction, is because going out and talking to customers and find out if they really have the problem you think they have and that they're willing to pay for a solution is also a pre-sales activity. It leads to your understanding of who to network with, how to sell, and how to package
And
it.
this particular founder has done that really well.
In spades.
Yeah, insanely well. He's gone out and talked to the customers and even sold some of the customers and got them on as beta clients before raising anything and coming to us. So and again, I do want to tackle, because a lot of time founders come up to me or to us and say, if I don't have traction or if I don't have customers, but it takes money to get those customers. No, it doesn't take that money. So, and for us, we don't look necessarily for traction. Traction really helps. If you're into revenues or onboarding customers, that's great. The more you have of it, it helps your project and your deal and makes you even more fundable. But if you don't have it, you better have that validation.
Yeah.
You have to have the validation.
But you're right that there are exceptions. Like we also recently invested in a company that had 40,000 in monthly recurring revenue already. When they found us, they were stalled in some things and needed our kind of training and mentoring to go the next level.
Right.
And we commonly see, after we've really, a lot of our work as business investors is not just throwing money at them.
Yeah.
We are training and teaching and helping them understand how it's truly done. And so what happens is, right after we give them the money, it's so fun. The first month, we usually see great sales and revenue increases.
Yeah.
And so,
And and a lot of times people come up to us and say like, hey, how do you guys know so much, or why are you so passionate about the Lean Startup and this building? It's because there truly is so much wasted energy and resources and time and money around building startups. And it just kind of annoys us to a point where it's like, we have to help as many people as possible understand what they're failing at and right the ship and get on the right track.
I don't even know if I've told you this. You might have heard me say it before, but when we moved from Seattle to Utah, you were just a teenager. And I came to Utah and I could not believe all of the startups in Utah I found that raised, at the time, this is circa 2002-ish to 2005, that raised like $300,000 to $500,000 from friends and family or angel investors, somebody. And they got this money in, had no clue on business model.
What they were doing.
Anything. It was crazy. They burned through all of it and then went back to investors and said, oh, I think I'm close. I need another $500,000. And it's just insane. And right there, the whole reason I got involved in entrepreneurial education and mentoring was to help stop the squandering of capital
and increase the chance and probability of success.
Yeah, but let's just look at the societal benefit. Right now, there's a fixed amount of available capital to startups. If that capital is going to very poor practitioners of startup entrepreneurship, and they squander the capital, that is a complete waste. That capital should be saved for those who arrive at a validated business model, and then they get capital that almost goes from venture to growth capital.
Yeah.
And we don't want to just give experimental, squanderable money to people that haven't done what is free to do, which is validate your business model.
And the general market's moving that way from the articles we talked about earlier.
It
They're
needs
moving
to,
that way.
but it's crazy. Steve Blank, the father of lean startup, introduced this circa 2007 to the world. I got introduced to it a couple of years later, tested my whole career, saw that it was true, back tested it, started employing it. It's been wonderful ever since. But even today, I predict out of all the entrepreneurship starting a company this week that less than 10%, maybe less than 2% will practice lean startup.
Yeah.
Which is insane.
Which is what, and so that squandering of capital is honestly a huge reason why there's such a huge failure rate in entrepreneurship, right? Yeah. So it's like, understand the basic principles of how to build business, to build a business model correctly, and then raise capital on that validated and proven factual business model.
I always say to people, if you can come and meet with me, look me square in the eye and tell me what you're doing, and I look you back and say, I agree, you have truly validated your business model. Now it's not a question of whether you're going to get the money. It's a question of whether you're the right entrepreneur to execute that business model. Yeah. That's the only question. Somebody's going to execute that business model. Is it you?
But if they're that well-versed and have done the validation work, they probably are the most experienced person to take it there.
That's an interesting point you bring up. Going through the lean startup process, the entrepreneurs that are truly doing it right,
they learn so much.
After a little while, I actually say this to them. I go, do you know, Mr. CEO, primary founder, you are probably in the top 50 worldwide out of 7+ billion people expert on what
this
you're
topic,
doing, on what you're doing.
This model.
And that's a true statement. I truly believe that's a true statement.
If executed correctly, right?
Yeah.
Okay, so we kind of diverted from the example of our number one, hopefully investable,
the
fundable
current company
project.
we'd most like to invest in right now.
Yes. But so to wrap all that up, I do think there's like a lot of attributes that we look for in an investable project. And honestly, it is weighted at times. Like it's like, some projects, like the traction trumps a lot of things, or some projects, a founder trumps a lot of things, or, covers up a lot of the other maybe minor red flags. We're probably not going to invest in things that are huge red flags. We'll probably just say, hey, you're not investable for us. We found this out, or done this thing, or done the due diligence, and hey, this is not a fit. But if there is such a big green flag, then there is a weighted process to that. That's what I'm saying. It's like, you can't just take this one recipe and say, okay, this is what I need to do. Here's how I'm going to be fundable, because there's strengths and weaknesses to every different thing. And I think a lot of entrepreneurs need to understand that. And that's why it's so cloudy when it comes to what is an investable, fundable startup. And so just keep that in mind, that you need to play your strengths, and you need to understand that there's a whole mass amount of attributes that we look for. And if you're ticking a lot of those boxes and strongly, then that becomes very
And there's
fundable.
a couple pre-qualifying assumptions to this conversation we could have said before it, is like, obviously, investable companies have to be scalable.
Yeah.
A small business versus a scalable venture, which I think we talked
there
about.
are
in our previous
foundational
episodes.
principles that have to be met.
Yeah. A small business is not set up for external investors to invest. Okay. It's the primary purpose of a small business is to have the founders make a good living, and they're not creating enterprise value.
Yeah. Or venture value.
A scalable venture by design is meant to actually create enterprise value. So all the stakeholders, shareholders gain their enterprise value goes up, and they create wealth.
So there needs to be basic attributes that have to be met, foundational things.
But given those assumptions, we're going over, okay, let's assume you're a scalable venture in a field of endeavor that we like. What turns us on then?
Then what comes after that?
Yeah.
So, okay, so we kind of went over that a little bit now. Now the next thing I did is we have an online community, and I went to our online community where there was a ton of questions that were posted about fundraising and funding and venture capital. And I kind of took a lot of those. And so I'm going to throw a couple of questions at you that come directly from our academy, from our online community. Okay, you ready?
Yes.
So here we go. Is it ever smart? This is from a question from our community. Is it ever smart to take money from an investor you don't fully trust?
No.
Why is that?
Trust is the basis of relationships. One of my good friends in life is Stephen M.R. Covey, who's the son of Stephen R. Covey, the famous author. Stephen M. R. Covey is also a famous author in his own right with a book called The Speed of Trust. And the whole philosophy behind that is that the more trust in a relationship, the less expensive and faster businesses move at, right? And activities go at. The less trust,
the longer
and
it takes.
the less trust in the relationship, the slower and more expensively it goes. Example, when people get into lawsuits with one another, they're not even allowed to talk to each other.
Yeah.
And they have to go through an expensive system of lawyers and courts. It's the worst of all worst, right, in human relationships. But one case that Stephen R. Covey used to tell, and where Stephen M. R. got a lot of his thinking behind his book from, was just that one time Warren Buffett went to buy a unit of Walmart, $400 million unit of Walmart. Warren Buffett gets with executives at Walmart he trusts. They have a meeting, they shake hands and agree to buy it. And in 30 days, a $400 million transaction closed.
Yeah.
Okay. Dissecting that out, it's because they left that and told their people, just get the deal done. A lot of times, merger and acquisition people, investment bankers, lawyers, accountants would want to string that out over 6, 8, 12 months, make a lot of fees, a lot of things. No, the speed of trust, the trust there. So back to startups. They need to trust their investors.
You need to trust your investor. And in fact, going back to that example that we were kind of talking about the attributes of this deal, I think we ended the call because we were pretty hard on this founder today. We were telling him a lot of things that he needed to fix and rectify before this was that we could actually invest and wire him any money. And at the end of the call, I think him and us, we agreed, wow, we have a really good working relationship where we can be honest and true and tell you frankly how it is. And he receives that and corrects the ship and moves on, right? And that's kind of what you need. You need someone who you can trust, you can rely on, that you know, okay, they're telling me something, they know what they're talking about. If there's any distrust between an investor and founder, it's just a train wreck waiting to happen.
An age-old truism in this line in the entrepreneurship world is when you take money from an investor in the startup stage, it's literally analogous to marrying somebody. It's a business marriage. And so what happens is, just like in life, marry the wrong person, terrible life. Marry the right person, wonderful life.
Yeah.
Same thing. Take in money. Everybody's money is the same money. It's the
money
same
is
money.
money, yeah.
Yeah. But take it from the wrong investor, terrible experience.
Which
take it from the right investor, great experience.
That kind of dovetails now into the next question that I pulled from our community. And if you have any questions, go to startupignition.com, create an account, and send us your questions. We will look at them. We monitor our community all the time. Here's what we do. So that dovetailing is,
and specifically it's Startup Ignition Academy. They got to click to create an account.
Yeah, create an account, and our community is free. Come in and mingle with other like-minded entrepreneurs. Okay.
Right.
Here's the next question that I pulled. Would you rather invest in a great team with a bad idea or a bad team with a great idea?
Oh, that's also an age-old question. It's way better to invest in an A team with a B idea than a idea with a B team.
Yep, execution.
100%.
Yep, execution is a lot of it.
Yeah.
Okay, here we go. Another one that I pulled. What is the number one mistake founders make in a pitch meeting?
In my opinion, the number one mistake is wasting the time. And let's set that up. Usually
that's a very general response.
Yeah, yeah. But I'm going to give specific. Usually you get anywhere from about 20 to 40 minutes up to an hour in a first meeting with an investor. Most entrepreneurs squander and waste that time. What you should do is take about 10 to 12 to 15 minutes max to give your pitch presentation with a slide deck, and leave the rest for Q&A. The Q&A portion is very, very important. That's when the investor sees what you're made of as an entrepreneur and whether they like you and want to invest in you and believe in you, because they are asking questions. But in your specific questions, what is in the pitch deck?
Yeah, what's the mistake founders make in the pitch meeting?
In the pitch meeting. So here's the number one mistake is at the beginning, you're going to go over, introduce yourself, problem, solution, use case, and all of that, and what the product is. They spend, like I've seen this when a person gets 45 minutes and they take the entire 45 minutes and they're not even off the problem solution statement.
Yeah. The pitch deck is not a marketing pamphlet, right? You're not trying to sell this investor for the product. You're selling them on the model.
The approach needs to be, let's assume the problem, solution, the use case, and the need are all there.
Yeah.
Okay, that's what most investors will do. They just want to hear those facts and what you're thinking. They'll go test that later and talk to customers and target market later and all that. But let's assume you've invented the next greatest thing since sliced bread.
Mm-hmm.
Okay, that's an old saying. You might not know that.
I know that saying.
Okay, but let's say that they do. Let's just say that's a given. But if you take just to get to there, 45 out of the 45 minutes you take, you have not gotten to the most important part of the presentation, which is how in the world are you going to sell this and generate revenue?
Yeah.
They want to know, let's assume your problem solution you're addressing
is
and
amazing.
your product is amazing.
Yeah.
Okay. How are you going to go to market, get revenue, and create a great company?
Yeah.
That's what they want to know. That's where you need to spend half of the presentation on.
Yeah.
That's not what people do. They literally spend 70 to 90% problem, solution, product explanation, and never even get to that.
Again, it's not a marketing flyer for them, right?
Yeah.
They're not a customer buying the product.
Yeah, so that's, I think, the biggest problem. There's lots of other problems, but that's the biggest problem.
Okay. Last question here that I have from our community and listeners. What's the best way to meet investors if you don't have any warm intro to any?
Okay. Well, first of all, let's start at the very beginning of that. If you've decided you're going to be a startup entrepreneur, you need to understand that you need to get out of your office and go talk to your target market, and you go out and mix and mingle with others in the venture ecosystem.
Yeah.
Let's talk the United States. Every major metropolitan market has a thriving venture ecosystem.
Yeah.
Some better than others, obviously. But if you're from Tampa, Florida, which I've had people from Tampa, Florida have mentored, and they say, oh, there's nothing like you have in Utah, because Utah is a really exceptional ecosystem.
Yeah.
It's amazing what's happened here in the last 20 years. But I'm in Tampa, Florida. There's no venture ecosystem like you guys have in Utah. And I go, no, that's not true. In 5 minutes, I can go on and find all of the thriving Tampa Bay venture ecosystem. Okay. And so you need to spruce up your LinkedIn and make it look like you're a serious entrepreneur, because people meet you and they go look you up on LinkedIn. And if you look like you're working for somebody else or just plain entrepreneur and you're not serious, they're not going to take you seriously. So you got to get your life in order and then start going out. Everybody has to eat. You should be meeting and talking to people for breakfast and lunch. Every venture ecosystem has activities every week, lots of activities. Go out and mix and mingle and attend these things and go out and meet new people. After a while, you might get bored of that and it might be less valuable to you. But at the beginning, you need to go build your network. And that's how you start doing that. And you get out and meet people. And so literally 3 or 4 days a week, you should be having lunch with other people.
Yeah. And we love getting referrals from people that we know. Our network is rather big, and we know a lot of people in our this state and all the surrounding states, and we get a lot of referrals. And I think we value the referrals into our firm way more than anything coming in cold. So it is about networking, meeting people that know more people. And that's
the practical steps to do it, because you don't want to be a startup entrepreneur and be myopic and literally sit in your apartment or home or wherever on your laptop trying to choose what colors your logo is going to have versus going out and talking to people in your industry and market and people in the venture ecosystem, investors, other entrepreneurs. One of the most valuable things any entrepreneur could ever do is find another entrepreneur in a reasonably similar type of business, like software business, and you're a software entrepreneur that's 6 months or so ahead of you in the ball game, and you take them to lunch and go, what was the number one problem the last 6 months and how did you overcome it?
Yeah.
And you start learning like that.
Yeah.
Yeah. That peer-to-peer mentoring like that, that's as valuable as going with an expert like me as your mentor from a sage wisdom type guy is a peer-to-peer mentor that's just 6 or 9 months ahead of you.
Because they've been down these paths before.
I've actually seen this happen, literally seen it happen in real time, where somebody that was 6 months ahead of somebody else, this person was over here talking and saying, I got this big problem. I think it's going to cost me $10,000. I can't afford that. And this guy was 5 feet away, who was about 6 months ahead of him, and goes, I can't help. I overheard what you said. I just figured that out and got it done for free.
Yeah.
Okay. Saving that guy $10,000. That happens all the time.
Yeah.
But, and so let me even back up some philosophies on this, Tyler, if I can. This is why I believe universities are still important, even though I think there's a crisis in higher education and most majors don't have an ROI and most degrees are not worth much.
Yeah.
But I think
you're preaching to the choir on that
I think
one.
everybody should go to a university for 1 year in order to have those collisions. They're called collisions.
Yeah.
What you want to have in your life happening is colliding with other people for networking, but it's just having these collisions.
And perfecting those soft skills, by the way.
And by the way, those collisions are where great ideas emerge from too. You might have an idea right now that we would call a hunch, okay? And then you meet somebody else and they have a hunch. And those hunches start colliding with one another, kind of like atoms bonding, okay, or to form molecules.
And it creates a new hunch.
And it creates a new, better idea to pursue.
Yeah.
And we've seen that happen. And that's what people need to go out and do. So
your overall answer is get out of the building.
My overall answer would be, in an academic way, saying you need to increase the collisions in your life with other human beings.
Yep. You can't just sit behind a desk or twiddle your thumbs, right?
Yes.
So get out and make things happen. Okay, we're literally at time. We're going to be at time.
It went fast.
Yeah. So we need to cut the episode, but to wrap it up, investors are changing their strategy. 2025 is going to be a good year. They're focusing on smaller checks, more traction.
They're not changing their strategy. They're following the path of the cycle.
Yeah, the path of the cycle, which is
hone it in. Right now, the highlight is going to be smart entrepreneurs that say, I can take your capital and be efficient with it and not squander it. And I'm going to follow good business principles. I'm not going to go spend $100,000 on stupid marketing that will never pay off. Yep.
I'm
not going to overhire by 100% and squander money on payroll that's mushroom.
Yep. Yeah. We went over attributes of a fundable and investable deal.
Yeah.
We talked about the pitch. We talked about current articles that are validating all of these thoughts for us. So thank you for tuning in. Subscribe, leave a review, connect with us.
Some people may think I'm biased, but I'm telling you, Jason Kalkanis, better be worried. You're the greatest moderator in the world now. He's in trouble.
I don't think so. Hopefully Jason doesn't see this. But hit us up. Thank you for tuning in, and we'll catch you next time.
Thank you.